Imagine slashing your tax bill by tens of thousands of dollars while securing both your business's and your family's future. Sounds too good to be true? Welcome to today's video on corporate life insurance in Canada, the hidden secret of many successful business owners. I'm Rozdeba from Dundas Life, and in the next 15 minutes, I'm going to uncover how this powerful tool can help give your business a serious financial edge. First things first, what exactly is corporate life insurance? Simply put, it's a life insurance policy that your corporation owns and pays for. But here's where it gets interesting. It's not just about providing protection, it's a powerful tax-saving tool. There are two main types of corporate life insurance. Term life insurance, which covers a specific period, usually 10, 20, or 30 years. It's simple, affordable, and great for covering business needs during growth phases or for key employee insurance. The second type is permanent life insurance, which offers lifelong protection. This includes both whole life and universal life insurance, which are great tools for estate planning and long-term tax strategies within a corporation. Now, why should you consider corporate life insurance? Let's talk about the benefits. We'll start with the tax advantages. In Canada, the small business tax rate is typically around 12.2% for the first $500,000 of active business income. Compare that to the top personal tax rate, which can be over 50% in some provinces. That's a massive difference. By using corporate dollars to pay for your life insurance premiums, you're essentially getting more bang for your buck. It's like buying insurance coverage at a steep discount. So let's say you need $1 million life insurance policy. If you were to buy it personally and you're in the top tax bracket, you might need to earn close to $2 million before tax to have $1 million left to pay for the policy. But if your corporation buys the same policy, it only needs to earn about $1.14 million to have that same million for premiums. That's a potential tax saving of over $860,000. Now let's talk about buy-sell agreements. Imagine you and your business partner have built a thriving company in Canada. Suddenly, your partner passes away. With corporate life insurance, you can receive a tax-free death benefit, buy out your partner's shares without scrambling for funds, and the deceased partner's family gets fair value for their portion of the business. This provides liquidity and peace of mind for the surviving partner and the deceased family, ensuring business continuity. The best part? The premiums for this insurance are paid with corporate dollars, making it much more tax efficient than if you were to fund this agreement personally. But wait, there's more. Corporate life insurance isn't just for partnerships, it's also crucial for debt coverage. As a business owner, you've likely taken on some debt to grow your company. Maybe you have an operating loan or a mortgage on your business property. What happens to these debts if you or a key person in your company passes away unexpectedly? The insurance policy's death benefit can cover your business debts, ensuring that your company can continue operating smoothly, even in the face of tragedy. In fact, many banks actually require this type of coverage when they issue large loans to businesses. It's their way of protecting their investment, and it should be your way of protecting your business legacy. Now let's talk about key person insurance. Every business that has one indispensable individual, the rainmaker, or the one who drives the company's success. What happens if they're suddenly not there? Key person insurance ensures that your company can weather the storm if you lose that team member. It provides the funds to cover lost revenue, recruitment costs, and keeps the business afloat during transition. Now let's talk about one of the most exciting aspects of corporate life insurance: tax planning strategies. This is where things get really interesting for business owners looking to grow their wealth tax efficiently. If you have a permanent life insurance policy, like whole life or universal life, owned by your corporation, you're not just getting the death benefit. You're also getting a powerful tax-sheltered investment vehicle. Here's how it works. Your corporation pays for the premiums with corporate dollars, which, as we discussed earlier, are taxed at a lower rate than personal income. Inside the policy, the cash value grows tax-free. Over time, this can accumulate into a significant amount of money, all sheltered from annual taxation. But here is where it gets even better. Enter the Capital Dividend Account or the CDA. The CDA is a notional account that allows corporations to distribute certain amounts to shareholders tax-free. When the life insurance policy pays out upon the death of the insured, the death benefit, minus the policy's adjusted cost basis, can be credited to the CDA. What does this mean in practical terms? It means that when the time comes, your beneficiaries can receive a significant portion of the death benefit tax-free through the CDA. It's like a secret passage that allows you to transfer wealth from your corporation to your heirs with minimum tax impact. Pretty amazing, right? Corporate life insurance can help you avoid what's known as the passive income grind. Recent changes to the tax laws have made it so that if your corporation earns more than $50,000 in passive income in a year, you start to lose access to the small business deduction. This is where corporate life insurance comes in handy once again. By moving some of your corporation's excess cash into a life insurance policy, you're effectively shifting it from a taxable investment to a tax-sheltered one. This can help you stay below the $50,000 passive income threshold, allowing you to continue benefiting from the lower small business tax rate. Now I know we've covered a lot of benefits, but it's important to also discuss some potential pitfalls to watch out for when considering corporate life insurance. First, let's talk about creditor protection. While personal life insurance policies generally offer strong creditor protection, corporate-owned policies may be more vulnerable. The cash surrender value of a corporate-owned policy could potentially be seized by creditors in the event of a bankruptcy or legal action against your company. It's important to consider this when structuring your overall protection strategy. Another potential complication arises when you need to transfer a corporate-owned life insurance policy. For example, if you decide to wind up your corporation or transfer the policy to a holding company, there could be significant tax implications. These transfers need to be handled carefully with your insurance advisor to avoid unexpected tax hits. Finally, it's important to consider the long-term implications of having your life insurance tied to your corporation. If you ever decide to sell your business or to retire, you'll need to have a plan for what happens to the policy. Will you transfer it to a new corporation or convert it to a personal policy? These are questions you'll need to consider with your financial advisor. Speaking of advisors, I can't stress enough how important it is to work with professionals who understand both life insurance and corporate structures. The strategies we've discussed today are powerful, but they're also complex. You need someone who can help you navigate the intricacies of tax law, corporate finance, and insurance products to create a strategy that's tailored to your specific business needs. When choosing an advisor, look for someone who has experience working with business owners in your industry. They should be able to explain these concepts clearly and show how they apply to your specific situation. Don't be afraid to ask for references or examples of how they've helped other businesses implement corporate life insurance strategies. At Dundas Life, our advisors are trained to work with business owners like yourself to determine your and your business's needs in finding the right corporate insurance policy. Let's take a moment to recap the key points we've covered today. Corporate life insurance allows you to use lower tax corporate dollars to pay premiums, potentially saving you thousands, if not tens of thousands in taxes. It can be used to fund buy-sell agreements, ensuring smooth business transition if a partner passes away. Debt coverage through corporate life insurance protects your business from financial strain if key individuals pass away unexpectedly. Key person insurance helps your business recover if you lose a crucial team member. Permanent life insurance policies can serve as a tax-efficient investment vehicle within your corporation. The Capital Dividend Account allows for tax-free distribution of death benefits to shareholders. Corporate life insurance can help you avoid the passive income grind and maintain access to the small business deduction. Finally, here are some potential pitfalls to look out for, including creditor protection issues and complications with policy transfers, which an insurance advisor can help you with. Running a business in Canada comes with unique challenges and opportunities. By understanding tools like corporate life insurance, you're setting yourself up for long-term success in our specific tax and business environment. If you're ready to explore how these strategies can work for your Canadian business, click the link in the description to book a free consultation with our expert team at Dundas Life. We specialize in tailoring these solutions to the Canadian market. Remember, the most successful Canadian business owners are always adapting to our changing financial landscape. By considering corporate life insurance, you're already ahead of the game. Thanks for watching, and until next time, here's to your business's success and financial freedom.